Hi, everyone. Welcome back. Trust you managed to stretch your legs a little bit and are now ready for our third panel discussion. So the next topic is the rise of new economy assets. In the last 3 years or so, we saw a huge change in our lifestyles with the adaptation of technology and digitalization, like going contactless and cashless, etc. And this gives rise to new economy assets, which presents very exciting new investment prospects. Here to discuss the current trends, risks, and challenges of investing in the new economy assets are our panelists, consisting Patrick Boocock, Chief Executive Officer, Private Equity Alternative Assets, Real Assets, Capital Land Investment, Abhilash Pasupuleti, Senior Vice President for Asset Management, Indospace Capital Advisors Private Limited, Kosei Hatakayama, Chief Executive Officer and Representative Director, MC Digital Realty, and Josh Deitch, Group Chief Investment Officer, ESR Group. The moderator for this panel is Shobit Agarwal, MD and CEO, Anarok Capital Advisors.
Thank you, Apriya, for this opportunity. Thank you, Kim, for the kind introduction. Alternate real estate assets is always a very exciting subject to be discussing. And we have a very, very power-packed panel representing diverse sub-asset class. On behalf of Apriya, I'd like to welcome all of you to a very interesting and engaging fourth session, which is titled Rise of New Economy Assets. I'm super delighted to moderate this, and let's try and give and make the most of this 45 minutes and sort of leave our audience with something to take away, since we have the privilege of having experts from around the world. We have somebody from Japan, we have Singapore, we have India. So thank you, Apriya, once again. Let me not sort of waste time. I'll go straight to Patrick. Patrick, you're the CEO and for private equity alternate assets for Capital Land. Let me start with you. Since you manage and look after real estate alternative assets in APAC region, let me simply ask and begin with saying, what are some of the trends in this sector, and who are the investors for this kind of sector? Why is this now becoming a sort of mainstream investment asset class? Is it ever going to become mainstream asset class? Patrick.
Thank you very much for that question, and thanks for everyone online to listen to us today over the next 45 minutes. I hope you find it productive. I'm Patrick Boocock, and I do lead Capital Land's push into alternative asset space. Let me just break down the conversation perhaps into three categories. Number one is just the macro opportunity in alternatives. When we think of alternatives, historically, it's been fairly close adjacencies to traditional real estate. But I think as we transition to net zero, we're going to find that the order of magnitude and the type of assets that investors can invest in is going to widen significantly. And there will be trillions of dollars of capital required to transition the world globally to a net zero position until 2050. So that takes us into very, very new asset classes that I think a lot of us are quite excited to get into. Specifically, however, for current trends in APAC, I think of changes, whether it's COVID related or not, but changes in consumer preferences, consumer lifestyle. We have aging populations in most major markets. We have obviously a significant increase in data consumption and the introduction of AI that also changes things significantly. And from a pure private credit perspective, we also see traditional commercial banks backing away from lending to traditional real estate sectors, which also provides a great opportunity for institutional investors. So specific to digital infrastructure, as we continue to roll out AI, we continue to move to the cloud, we roll to 5G, and then the next generation after that, once we start getting into autonomous driving, the level of data consumption is going to increase significantly. And I think as a result that asset class, we're seeing significant interest from investors due to the growth prospects. As I mentioned, a lot of commercial banks in the region are backing away from lending to commercial real estate and other real assets due to regulatory requirements. So we're seeing a lot of investor interest in private real asset-backed credit. Again, whether that's traditional real estate or other alternative asset sectors. So I think that's an area of considerable opportunity. Other niche spaces like self-storage, where in addition to the traditional 4Ds being death, divorce, dislocation, and downsizing, we're also seeing some secular tailwinds growing the self-storage business, including urbanization, an increased proportion of renters, and frankly, as e-commerce grows, we're seeing a lot of small end retailers using self-storage effectively as their logistics facility. So we're seeing quite a lot of growth in that sector. And then, of course, as I mentioned, as both the population ages, and I think a lot of us start to, especially the younger generations, focus more on healthcare, we're seeing a huge growth into health-related assets as well. So those are thematically some of the things that we're thinking about here at CapitaLand. And of course, as I mentioned at the beginning, if you round all of that around a world where we all want to decarbonize, there's a whole investment universe around renewable energy, and that comes with its own set of opportunities. And it's not just solar panels and wind farms, it's everything in between and to the end. It's battery storage, it's other technologies, it's electrification of public transit, electrification of cars, etc. So that's where I'm seeing the opportunities. Where am I seeing investor interest? I would say all of the above. I think institutional investors are really trying to figure out the new paradigm, how we're all going to live, work, and play in the future. Real estate will continue to be a dominant asset class, no question. But what I am seeing now in the current environment is that investors are looking for more niche strategies in some of those areas that I just mentioned.
Thank you, Patrick. That was very, very crisp. You're saying 4 sectors within alternative asset class, that's data centers, warehousing, self-storage, and healthcare, which are all beneficiaries of the global change, whether it's consumerism or the ESG requirements. So what you're really saying is that it requires a lot of money to seed all of this change, and it's mandatory because the consumers want it. And therefore, investor interest will continue because there's demand on this. But it's quite easy, and the fact that we still call this alternate asset class is primarily because I think world is overinvested in offices and retail centers and multi-families. Now they have to figure out what else can be done with and where can we find the value, which is why I'm going to move to Josh. Josh, you manage and operate assets in multi-countries. You've raised multiple funds, especially around warehousing and data centers. What I find that when we talk to investors is when they are looking to invest in alternate asset class or this sort of sector, they're not looking for managers who are simply looking at yields. They're looking at managers who can create value by working on them. And it's a bit of a trick saying they want return, but they also want you to find the value and how to find the value. And Josh, nobody better placed than you who got operating assets in multi-cities. How do you do this? How do you crack the code where investors get a very good risk-adjusted return that kind of compares with what they could have done with offices, and yet you are an alternate asset class?
Well, thanks, Shobit, and thanks to Apria for the opportunity to speak. I think we have a philosophy in ESR that, in terms of like the warehouse business today, it's not really real estate, it's really infrastructure. And when you think about, the titans of industry in the 19th century is the railroad barons, because all of commerce kind of traveled on the railroads. Well, in today's kind of e-commerce direct-to-consumer distribution model and supply chain model, it's really going through these modern warehouses. And so, we believe that there is kind of long-term value in these large distribution centers in major consumption markets across Asia, which is the fastest growing market, in the world. In terms of kind of the finding value and kind of, value added services and how you differentiate, I definitely think there also just has been an evolution in terms of what a modern warehouse is versus what it used to be. Industrial real estate, was thought of as a very dirty business, 15, 20 years ago. And today it's one of the darlings of the investor world in terms of trying to take advantage of this mega trend. But, whereas the old warehouse was really built to store stuff, boxes and goods and whatnot, today is very different. And the whole supply chain of kind of from manufacturer to the distribution center, to the retail outlet, to the consumer is now direct to the distribution center and then out. And so fundamentally, the construct of the warehouse has changed. And whereas it used to be just to store goods and sometimes cross-docking where goods come in one door and out the other, now there's a lot more labor involved and people and much higher level, jobs, because you have engineers, you have automation equipment, et cetera. And so in many of our markets, like, Japan, for example, where, I think the demographic challenges in Japan are pretty well known, usually and historically, I think tenants have come to us and said, look, where's the on-ramp to the major freeway? And, what's the ingress and egress of this facility? And those are still very relevant questions. But today, a more pressing question is, where am I getting my work? And how am I going to keep them here? And so at ESR, we have this philosophy that we call human-centric design, where we're no longer really building the buildings for just the boxes, we're building the buildings for the people. And so, we're doing things like creating very, very high-end common areas where our cafeterias and our break areas look more like kind of the lobby of an Andaz hotel, not what you would think of a typical break room in a warehouse. An example in Japan, again, is that for our larger warehouses, we're actually building in childcare facilities, which is free to the tenants' employees to try to bring women back into the workforce. Because again, the labor market in Japan is so tight and health and childcare in Japan is so expensive. This is a phenomenal benefit. And what's happening today is that when we put up now a big sign that says, ESR in terms of developing a new site, we're getting local women in the community that are trying to find out who the tenants are going to be so that they can apply for jobs because they know that this is going to be a benefit. And so how does that translate into value to the investors? Well, ultimately, it's through the tenants. And so when we bring a CEO of a company who might have 200 or 300 people that are working in this warehouse, and they're thinking of how am I going to attract people? How am I going to retain people? And they look at all these amenities, if you will, and these are very highly amenitized warehouses. They're very attracted. And so, year to date, we've leased over 2 million square meters of new space, and our portfolio is 98% occupied outside of China. So I think the proof is in the pudding. But I think that we're very good at execution, but the kind of man warehouse is reserved.
So say that beyond your thinking beyond the boxes, and you're saying almost you're sounding like you're adding services to it, saying you're becoming very, very service oriented to your clients, bringing in value adds, whether it's in terms of healthcare for their staff, daycare centers, bringing women back to the workforce. I mean, this is quite amazing. I'm going to continue with warehouse, and I'm going to go to Abhilash. Abhilash, you've got the largest in India. You are operating across many, many cities. Within the emerging asset class, you're also in emerging cities. So how does that feel? What's the real learnings from operating warehouses in multi-cities in India?
Yeah, thank you, Shobit, and thank you to Apriya for this opportunity to speak and participate in this panel today. I think you're absolutely right. So we've been at it for about 15 years. A lot of what Josh just touched upon are things that where, as far as India is concerned, we are still pretty much nascent in terms of evolution. But we've seen the sector mature significantly from the time we started this business back in 2008. The way we have grown as we started off with, I think, again, the key demand driver for us when we make decisions around investment is we look at population, we look at demographics, we look at demand drivers. And the way the sector has evolved, at least for us, is earlier a lot of our development strategy was dependent on, well, first, if we take a step back, when we actually started this business, there was no concept of institutional warehousing and institutional industrial real estate in the country. So you were really working with tenants, working with landowners, working with the government authorities to first build awareness of the importance of having an institutional player come in and set up shop, and the value add that it would have, it would generate to tenants and communities, and that was really the heavy lifting. Along with that, in India, particularly, what gets even more complicated, as most people on the panel would appreciate, is land acquisition is not really is relatively much tougher in India. So we started off with really concentrating on the top 2 or 3 markets where you could kind of expect demand. You had multinational companies that were already there. They were servicing their clients through buildings that were subpar, grade C, if you're being generous, with leaky roofs and floors that would cave in. So that presented also a great opportunity as well as a challenge. The opportunity was low-lying fruit. I mean, you just put a box together that kind of doesn't leak and the floor doesn't cave in, and there you suddenly had a conversation starter with a tenant. And that's how the market has evolved. Where we are seeing now is, particularly on the back, as everybody's emerged out of COVID, particularly in the last 2 years, is there is a lot of demand and supply tension that's currently in the market, where I think the supply has not really tracked what everybody was expecting it to be in the last 2 to 3 years because of various restrictions. So that's created in the industry, perhaps for the first time, is a great tension between demand and supply, which we're seeing in terms of rent growth. So as a strategy, what we have done, and most of our peers and competitors have done, is now there is a lot more emphasis on putting out speculative supply in the market. Whereas you dial back 2 or 3, even to as recently as 2 or 3 years ago, a lot of the development was tenant-led, and it was mostly pre-leased BTS development that was going on. So that's one big change that we've seen. The second thing is, like Josh rightfully mentioned, we are thinking of this as infrastructure. The government is thinking of it as infrastructure. The banks are thinking of it as infrastructure. So that's just opened up a whole new plethora of financing products that are available and make it relatively easier to kind of finance this and put the space out. So I think in summary, our learnings, we today have a portfolio of roughly 58 million square feet. We are across 11 cities in India. We continue to be very excited about the opportunity to potentially double this presence in the markets that we are present in, and that's really based off demand and the relatively underserved tenant demand that we're seeing in each of these markets.
So you're saying tables are turning, you have to build more speculative in India, but as we heard Josh, I think they have kind of evolved, saying, space is enough, but we have to add value within those parks because Japan is at a different position with India. So I think quite an interesting sort of perspective between India and Japan. At this point, I'm going to sort of switch a little bit towards data centers, and I'll bring in Patrick first. Patrick, you've got 26 data centers across Asia and Europe. You've announced a new fund around China data center strategy. I just wanted to ask, since you have such a large operations on data center, what's your key learning? How would you sort of do things differently given your experience of making all these data centers? What's the big change that you are seeing? And what's going on in China vis-a-vis data centers?
Thanks, Shobit, for the question. You're right. We in fact, we have 27 data centers now. We announced an acquisition in the UK very recently. So we're over 500 megawatts of power. We have fully integrated teams across UK, Europe, India, Singapore, China, Korea, and building in Japan. And that's across, when I say fully integrated teams, we've got people responsible for design, operations, maintenance, importantly, customer management and customer connections. So we've got a diversified portfolio. We've got both stabilized assets and assets under development. So we've been learning over the last 2 or 3 years quite a lot. I guess, look, the main takeaway for us, just given the sector, is you absolutely need to be at the forefront of technology and understanding what's changing in the data center market, and also understanding what your customers ultimately are going to want. So, for example, hyperscalers in China, they have different design requirements than Western style hyperscalers. They need to be at the forefront of knowing both. Of course, you'd like to standardize design to the extent you can, but that's not always possible. We're spending a lot of time, obviously, on procuring green energy. I mean, the data centers are great for all of the reasons we well know. They're very positive contribution to society. They help us they help people communicate around the world. They help with research and R&D and all sorts of benefits, but obviously they are large consumers of energy. So we spend a lot of time on our understanding the best principles of design to minimize the carbon footprint on operations. And then, of course, to the extent possible, procuring green energy as well. But I would say the one thing that we've learned the most is the market is very local, and you need to have boots on the ground in those individual submarkets to know what's really happening, and you can get caught out in some cases with oversupply. So again, having our integrated teams in our major markets has proven a real benefit to us. And again, one of the dynamics around data centers, given they're such large energy users, are finding appropriate sites that have sufficient power energy requirements on those sites, and that often requires quite a bit of finessing with the local utility companies. If you take Japan, for example, and I'm sure Kosei will talk about this, you need to be very, very close to the local utilities in order to secure power, and power in a reasonable time frame that makes economic decisions feasible. So those are the key learnings we've had over the course of the last 2 or 3 years. I would say the other thing that I think a lot of data center operators are looking at, a year ago, it was all about last mile data centers, edge computing. I think the thing that's really sped up in the last 6 months has been the impact of AI on data centers. So ourselves as a data center owner, operator, our end customers, and having had a conversation recently with one of our customers, everyone is trying to better understand the implications on the data center industry as a result of AI.
Thank you, Patrick. I think I'm going to continue on data centers, and I'm going to bring in Kosei-san, since he's building some data centers in Japan, you mentioned. And I want to talk to him specifically on 2 things, which you also touched upon, saying data centers are big guzzlers of energy. And also they produce a significant amount of heat, and they require cooling on the technology side, because unlike warehouses, there are more machines within data centers and less people. So, Kosei-san, what's going on the ESG side? What's new? How do you balance this? Given everybody wants carbon neutral, everybody is trying to meet their ESG norms. What's going on in data centers?
Okay, thank you, and asking, and also warm welcome. Prior to that, let me provide a clear overview of our company's positioning in Japan. So as the joint venture between Mitsubishi Corporation and Digital Realty, our MC Digital Realty primary focus is on expanding businesses within Japan. So our entire portfolio we own and operate based within this nation. So I think it would be helpful to understand comprehensively. Let me start with the economic pie we look at. As Patrick implied a little bit. So it is important to note that our shareholder Digital Realty has an impressive track record of owning and operating over, let's say, 300 data centers worldwide. And when it comes to geographic diversification, the APAC revenue contributes to 10% of Digital's entire revenue, reflecting its presence within the market, but seeing larger potential, Among the APAC countries, let me emphasize that Japan stands out as a particularly promising market. expected to have robust growth with, let's say, 12% of CAGR basis. And this growth is concentrated in the key cities, Tokyo and Osaka, so where the demand is steady on the rise. Also, here's one thing I want to give you for consideration. While there is evident that demand is outpacing supply, for sure, the pace of growth is relatively slow for the moment, which is partly because of some technology issues, as you mentioned, and also some very fierce constraints in the competition market. So adopting a cautious but optimistic approach, we anticipate substantial surge in demand in the long run, especially driven by increasing need for AI technologies. And let me add one thing also. I would say the current regulatory environment here is relatively permissive, which is one of the aspects we have to be mindful. So to foster a truly competitive data center competition, I hope clear and well-defined regulatory guidelines can promote fair competition and drive innovation in this universe. That's one of my belief. And yeah.
Thank you, Kasai. You're saying that regulatory environment makes a massive difference, and Japan is opening that up, and hopefully it'll impact or it'll make some changes in the innovation that can be brought about on data centers. I'm going to move to Josh on ESG. I'm going to continue on ESG. You mentioned two things. You mentioned during the speech just now that you're adding a lot of values. You're bringing amenities into parks for a variety of reasons. And of course, you're also sort of conscious about ESG. My question is, how do they impact investment? Because both of these require additional costs to meet ESG as well as to add amenities. And by the way, do tenants really value it in dollar terms? Do they really give you more money for a park which is differentiated, that has zero net carbon, that has all the amenities? Is it really impacting, or does it just mean that your leasability goes up but not the value?
But yeah, and it's a great question, and I mean, you know, I've been in the industry for about 30 years, and we've been talking about ESG. I don't know about 30, but for a long time, you know, it's been kind of on the radar screen, and I can say that in the last 3 to 4 years, that the pace of change and kind of drive in terms of ESG has been faster and more severe in the last 3 or 4 years than in my whole career. And I think that it obviously, and for the right reasons, because we have some serious climate problems, but that's a different panel discussion probably. But I think that what's happening now is that the entire ecosystem is demanding ESG compliance, and that it's not just the tenants, but it's the capital, and, you know, driven by the equity providers and driven by the lenders also. And so I think that that has been very helpful for us in the industry as kind of driving the change and requiring the change. So right now we're in this pace of kind of, you know, we're past the pioneers and now people are starting to adopt. And when we think about, like, for example, many of our tenants are multinationals where we have occupancy requirements across borders. They have their own ESG internal requirements in 2030 and 2050 goals. And so it is a key differentiator and almost now a binary decision when they're making new occupancy choices. And so it's not how much more do I have to pay? It's like, I can't go into a building that doesn't have any kind of sustainability, you know, benefits, et cetera. And, you know, we have been very focused on this at our group. And on the credit side, you know, we've raised $4 billion of sustainability linked loans. You know, we have almost over 10 million square meters of roof space in terms of our ability to roll out solar. You know, solar is not the panacea, by the way. You know, we're going to need additional sustainability and green energy in order to kind of offset our own carbon footprint. But I think that there are definitely tenants that are willing to pay the premium. And we have lots of discussions too when we're doing new builds about the spec and the additional cost of some of these components that many of these multinationals will pay. Now, having said that, there are many local tenants, and especially in more emerging markets of Asia, that, just like any kind of development model, is that they don't see the value yet to pay. And therefore, they're maybe priced out. But I think that for all of us on this call who are kind of raising institutional capital to help us kind of build our businesses, that's what's the tip of the spear, because the equity providers and the credit providers have now these mandates. And I think it's a matter of time. And when I say time, I mean 3 to 5 years, where if you don't have a green building, you're not going to be able to get it financed.
So you're saying ultimately it's going to be regulated and it's going to become mandatory. People will have to start building green, and at some point they'll have to start paying for it because it's not going to work otherwise. There is an additional cost that's required. I'm going to bring in Abhilash and maybe Patrick together, one after the other, of course. Abhilash, you mentioned you started to build speculative warehouses. So I want to ask, is this what percentage of your new development is speculative vis-a-vis build to suit or build to custom with the tenants? And Patrick, would you do that given that for every megawatt that you build as data centers, it's really expensive. It's the high end of cost. Would you build speculative? Would you build speculative data centers and then look for tenants subsequently? So Abhilash, maybe you can answer and then move to Patrick.
Yeah, sure. I think it's a lot more easier to do it on the warehousing side because, it's really pretty standard with respect to what we expect. We continue to invest in markets we know well. We can forecast demand pretty accurately in most markets that we are present in, and that forms the basis of our decisions to go a little higher on the speculative supply in some markets rather than the others. Now, if you look at where Indospace is currently present in, we have a large portion of our portfolio in the top 8 cities in the country. And these are cities where we feel pretty confident about demand coming in. So those would typically be places where we would kind of be okay to put out speculative supply. We also have the track record of having established various parks through different investment vehicles in each of these markets. We have a strong network of tenants, so we are able to reasonably forecast that, and that really forms the basis on which you put out speculative supply. When I think typically the reason why we didn't do that previously was because we were just figuring it out like anybody else. So I guess the answer would be that if we were to enter into a new market, I think we would kind of try and see maybe for the first 1 or 2 buildings, try and get a tenant in. But in any of our existing markets, we feel pretty confident about putting speculative supply out. Because the product has become pretty standardized with respect to tenant requirements. There will always be minor additions or deletions that you have to do to your specification, which it allows you to kind of adjust to as you're through the development cycle. And thirdly, the big advantage of the industrial warehousing asset class is you can have parallel buildings that you can always construct. So if you have a 50-60 acre parcel, you start with a few speculative buildings. If there is a tenant requirement that you have to cater to, which is very specific, you still have the ability to start a third building and put that up. And for that, really what's important is to have your financing tied up. And that's where you differentiate yourself with the rest of your competitors is you have established a track record. You kind of have all the right equity partners that are backing you. You have the right financial institutions that are backing you, and that really is what helps you determine the strategy.
So Abhilash, needless to say, you feel confident that if you build speculative, you'll lease it.
Yes,
so it's not that
absolutely.
much of a risk. Moving to you, Patrick, between hyper versus colo, how do you work this out? Do you given that you have to spend too much on building these data centers, they're not easy to build, they're not cheap, definitely. How do you manage this? How do you balance this?
Sure, Shobit. So look, I think the first thing to remember is that, roughly speaking, 2/3 of the cost of a data center is in the M&E. So when you're looking to secure and acquire a site, it's generally a pretty small component of the overall development cost. The second point I'd make is that end customers, particularly hyperscalers, typically don't want to have a conversation with you until you've secured the site. And in the case of colo/enterprise, they generally want to see you coming out of the ground with core and shell. So to answer your question, in many cases, you do need to start developing on a speculative basis, but you can phase your approach as well. As I mentioned, if 2/3 of the cost is in the M&E, then once your core and shell is up and you're actively leasing, you can start investing in the M&E once you have more conviction over your leasing strategy and having tenants on board. Now, you raise an interesting point about hyperscalers versus colo. At the end of the day, look, it's great to have hyperscalers as clients. They're high credit worthiness. They enter into long-term leases, but as a result, they drive a hard bargain. And that obviously impacts investor returns, where enterprise and colo, shorter term leases, perhaps not as strong credit worthiness, but you as the owner can command a higher premium on rent. So in many cases, we take a balanced approach to our leasing strategy. And in some cases, we find that both hyperscalers and colo actually want to be co-located within a data center campus. So there's actually some operational benefits of having both nearby as well.
And thank you for that, Patrick. And I'm just going to stay with you a little bit more. You're also doing or actively investing in self-storage. How deep is this market? Where is it rooted? Where does it make sense to do self-storage? Many of the other countries in Asia have not started with that concept. Of course, Singapore, Japan, I guess, is doing it. China is doing this. So what's driving that sector? How does it? What's the opportunity size? And who are the typical investors in that market?
Sure. So as I mentioned, obviously the self-storage sector is well established in markets like the US and Australia, where it's much more of a big box type format, and that market is well understood. And we're interested in those markets as well. But as we look across APAC, given the continued urbanization of cities, as I mentioned, in addition to the traditional 4Ds, we're also seeing because of urbanization, we're seeing smaller residential unit sizes. We're seeing more single family households. And as a result, the demand for storing things outside of your individual residential unit is increasing. So that's demand driver number one. And again, the way I refer to it is sometimes in Western markets, you're storing your father's Corvette. In Asian markets, you're storing your golf clubs and your ski equipment for the winter season. So the actual physical space is small, but given the density, the unit numbers are much higher. And that's what we're seeing a trend for. And the other big trend that we're seeing is in the e-commerce side, where a lot of these small to medium-sized retailers, they don't have the financial means or the need to take on large space at traditional logistics, and are in many cases using self-storage as a solution for them. And then thirdly, what we're seeing from a pure operational perspective is an increasing technology side of things. So again, I used the golf club example, where instead of spending 30, 40, 50 minutes of your day traveling to the self-storage facility to get your golf clubs, you have someone bring it to you. And that's obviously, automation is a big part of that. So from my perspective, it's almost becoming storage as a service in many cases as well.
Wow, interesting. So you're saying it's just a rapid urbanization, shrinking houses, technology coming in, that's driving the demand. Josh, can I bring you in here? Right, you've done loads of warehouses, which are sort of the boxy, out of towns, distribution centers. What are some of the new trends? We spoke about last mile. We spoke about multi-story. Are these now sort of becoming applicable across regions, or you're seeing, Japan behave differently to India versus Australia? What's going on? What's the sort of product? What will you be spending most of your time in the next 2-3 years doing on the warehouse side?
I mean, I think definitely, Asia is a very heterogeneous market, and Japan is very different than India and Indonesia and China, et cetera. And so there are market dynamics in obviously each market. And the reality is, I think our perspective, Shobit, is that we're not really focused on kind of an overall Asia strategy. We're focused on distribution in major centers of consumption. And so I think the trend, and so we've seen, for example, on multi-story, which I think is one of the key trends, that, it's been big in Japan, it's big in Korea, it's started to be, pretty significant in China, in the major markets. And the whole concept is that when you have this concentration of population density, naturally, obviously big in Singapore, real estate values increase and land becomes more scarce, and therefore it becomes more economic to go vertically. The reason why I don't think it's really taken off in the US and places like Australia yet is because they're not short on land. And therefore, the values haven't necessarily gotten to the point where you can pay for it. Having said that, as these markets continue to evolve, it will happen. And so, there is multi-story that's being developed right now in Sydney. There is multi-story in Seattle and Vancouver and in New Jersey. I don't think you're necessarily going to see it in Kansas City, but, in the major markets in Asia, especially a lot of these major population centers, and where we're in Seoul and Busan and Tokyo and Osaka and Nagoya, but also in India, where there's a lot of urbanization still happening, I do think you will see it. Because the other thing is, when you think about from an end user perspective, the majority of the cost in terms of supply chain is not their real estate rent. It's transportation and labor costs. And so if they can shorten their transportation costs and attract more labor in a more urban environment, you can save a lot of money, even if you have to pay slightly higher rents, because the construction cost for going vertically is greater. And so, that is one of the key megatrends. I do think that multi-story will continue to expand, but it won't be broadly across all markets. It's really going to be focused on these concentrated, densely populated major centers of consumption.
Super. So two takeaways. You're saying that urbanization and dense urbanization. You, of course, are saying multi-story warehouses will come in. Patrick is saying self-storage will also probably come in, because it's a byproduct of dense development and shrinking spaces. Kosai-san, just one question for you. You mentioned, that regulatory constraints around energy and their intensity will continue to create problems in building new DC. How much, to what extent is this correct? That you'll have issues around energy and policies around energy. I thought all governments want data centers to be built. They are all looking to favorably change policies to bring about creation of data centers. But let's have your view on this.
Well, should be too hard to precisely answer. However, to be clear, I do not see regulatory constraints, but rather I would say the market here, surrounding regulatory environment is relatively permissive. In the other words, I would say, okay, when it comes to procurement of power, here in Japan, I would say the rule is first come, first served. First apply, first served. That's a things looks weird because our philosophy is we are very emphasizing the importance of the customer satisfaction for sure, and also real demand is a very essential to advance our operational basis. However, kind of speculative on the order or application would make the competition a bit weird. So my point was, well, rather than the constraints, but rather I wanted to emphasize the fair kind of competition with transparency. That was my point.
Okay, understood. So you're saying first come, first serve is a little sort of not so nice policy to have. You should allow when you want those power to be upgraded to do that. Interesting. I'm just going to move one. We've got last literally 3 minutes left, and I'm going to move the panel a little bit on top, saying, what alternative asset classes, in our view, on my view, and I can check whether all of us can vote for it, really thrives in two scenarios, right? So the investors putting money in this sector love alternate asset classes in a low interest rate regime. That means you can go when the interest rates are low, you can really leverage yourself, make some money. Interest the IRRs at the development yields become more attractive, and people say, okay, let's go find alternative asset classes, whether it's education, healthcare, self-storage, data centers. Versus there is a set of investors who think putting money in alternatives is a great hedge for inflation, right? Let's put this together, and you know what, if you invest in alternatives, you want to probably at least make sure that you hedge the risk in a bad market where there's high inflationary environment. I want to check, and maybe starting with Patrick and then Josh and Abhilash and then Kosai-san's, saying which of the two philosophies you think the investors fall in, or is it a balanced philosophy? So it could be none of the above as well.
Sure. So look, I think for me, I think it's the latter, which is it's a balanced approach. I think if we take a step back and we look at what alternative assets are, generally they're assets that underpin the backbone of the new economy. They offer resilient, ideally inflation-protected cash flows with long duration asset lives. So I think the key issue, regardless of cycle, is that owners of alternative assets appropriately manage the capital structure. So we've seen time and time again, great assets that get distressed during periods of economic volatility because of poor capital structures. I think that's the most important thing from an investor's perspective to consider. So again, I'm very bullish on alternative assets. Of course, you obviously always need to consider the entry point and at what point in the economic cycle you're entering, but managing your capital stack appropriately is quite important. I mean, a period today of higher inflation, you're probably better placed to think of, if you can, either long-term contracts that have inflation protection embedded in them, or if there's no inflation protection, then you want to look at assets that have short whales associated with it, like multifamily.
Absolutely. Josh, over to you.
Yeah, I mean, I agree with what Patrick said. I mean, I think fundamentally, alternative asset classes and demand for those asset classes are really driven by, ideas of supply and demand mismatches. And so they're different asset classes that generate recurring, repeatable cash flows. And that's why investors are attracted to it. So the concept of these only work in a low interest rate environment is I think false. I think everything works better in a low interest rate environment in real estate where you can finance less than your cap rates. But I think that there are just fundamental drivers that continue to exist. And the whole concept of alternatives is that it's non-correlated. Whether it be education, healthcare, data centers or warehouses, there are these secular shifts that are creating demand, which make it an attractive investable asset class.
Interesting. So you're saying it is because it is not correlated to both of them, and then Patrick, of course, said that it's gives you the inflation hedge. Abhilash, what's your view?
I completely agree with what the two of them said. I think it's a fantastic asset classes to be invested in, precisely, if not for anything, that it kind of mirrors the economy, the backbone of the economy, and it's absolutely fundamental that these asset classes continue to flourish for the economy to move forward. I think it was proven beyond doubt as we got into COVID and we came out of it. That only further intensifies my opinion about this. I'm firmly on the side that low interest rate, high interest rate environment, in both cases, this is a very attractive investment opportunity.
Understood, Abhilash. Kosai-san's.
Hi, almost same here. So from my standpoint, our data center assets may not fully offer complete hedging, but they do exhibit resilience to market fluctuation because of the longer and stable cash flows and higher occupancy rates also. And basically, these rentals from tenants are influenced by supply and demand dynamics in the market. but they also incorporate, individual risk assessments into the pricing mechanism, and that can help mitigate some of the effects of market volatility. That's my big point.
Okay, and that really, thank you, everybody. I really want to thank everyone. I think we've run at the end of our 45 minutes. I think very, very interesting session. Just to sum up, you're saying alternative asset classes are here to stay, not just because they give either an inflation hedge or sort of work in low interest rate environment, but fundamentally that there is demand for it because of rapid urbanization, consumerism, changing logistics, supply chain, and so on and so forth. So these sectors will continue to deepen and perhaps at some point lose the tag of alternative and come into the mainstream, probably 5 to 7 years from now. I'd like to thank Patrick, Josh, Abhilash, and Kosai-san for taking out their time today, and Apriya for giving us all this opportunity. Thank you very much, and hope the audience has taken away something. So thank you all for attending. Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you, gentlemen, Shobit and panelists. That's right, with the changing lifestyle, real estate development has also evolved so much so that it's not just constructing a building, but rather constructing something with value adds to meet the needs of the users.